Welcome to another episode. You are on the air with the Freedom Real Estate Podcast. I'm your host, Artem, and this is our boy, Andrew, millionaire investor.
Let's go.
How are you feeling today, Andrew? Ready to do this?
Pretty fantastic. Let's get the show on the road.
Sweet. We got a real juicy one for you. We're going to dive right into it. Andrew, you've been doing flips for a while. I've been doing them for a few years. Let's go through our top 5 most expensive fixes.
Sounds good. So some of the most expensive fixes I've ran across, number one, obviously the foundation. The foundation can get very expensive very quickly. And that could be a retaining wall. That could be redoing the actual LVP or the joist holding up the building. And that could be simply doing lolly columns that actually support the actual structure of the building. So foundations can be very costly. They can range anywhere from, a couple $1,000 upwards, a couple $100,000, right? So foundations can absolutely be a scope creep. And if there's any question in hand, you're absolutely going to want to get a mason on site to give you an accurate quote.
Mm-hmm. Number 2 for me is roofs. And those are kind of hard to look at, especially if it's a taller building. You might want to bring a drone. They're pretty cheap these days.
Yep.
But roofs, if there's an active leak, or if when you're doing the walkthrough, you can kind of see that there's running of water, even if it looks dried up on the walls, definitely check out the roof. Roofs can be anywhere between 20 and 40 grand, depending on the building for a small residential. And you got to stay away from the flat roofs that we have out here in Northeast, because the flat roofs, they really collect water and they have to be repaired more often. So that's a big one for me.
And here's a pro tip when it comes to roofs: plywood. So underneath the shingles is actually plywood. And then when the roof is old enough, that plywood is rotted and you actually got to replace that plywood. And that could increase the cost of the roof by upwards of 33%, right? So it can get very expensive very quickly. Additionally, more shingles. A lot of times you get 3, 4, 5 layers of shingles. And what does that mean? That means more labor costs to get rid of them. That also means more dumpster costs to get rid of the actual extra shingles, right? And lastly, look in the actual closet on the top floor. A lot of times the owner will forget to paint the inside of the closet, and you could see if there's any leaking from the roof. It's an easy way to find a leak when, owners are trying to hide the fact, right? So number 3, a septic. So when you buy a property, a lot of times it's either on town sewer or water, or it's on septic. And when it comes to septic, that can get very expensive very quickly. So septics can run anywhere from $30,000 to $50,000 depending on the size. It can run even higher, right? And when it comes to a septic, those are essentially, restricted by the bedrooms, right? So when you buy a property, say it's a 4-bedroom property, you should expect that septic to support 4 bedrooms. But if your actual business plan is to make that property into an 8-bedroom property, you actually most likely have to update that septic to support 8 bedrooms, right? So septics are a really easy scope creep that many people forget about.
Number 4, electrical issues. Now, electrical can be kind of tricky because if you're walking through a house and let's say a light bulb doesn't work when you're toggling the switch, that could be pretty easy. It could be just a bad wire or one bad circuit, or it could be indicative of a much bigger issue with old wires, especially those cloth wires from the 40s, 50s that wear out. And if you're doing a big project like a whole gut renovation and you have to redo the entire electrical in the whole house, that could be anywhere from $30,000 to $50,000, sometimes more. And you can get 3 quotes from 3 different electricians. They'll give you wildly different prices depending on what they think the labor will be, and you won't really know until you really get into it. You have any thoughts on that one, Andrew?
Yeah, so when it comes to electrical, like Artem mentioned, the scope can increase very quickly. And a lot of people don't realize that when you walk in these properties, especially these older multifamily properties, like they're over 100 years old, right? And you got to think about it. That electrical has been done 3, 4, 5 times over with very old technology. So most likely, you're going to have to upgrade behind the walls with potential knob and tube. But not only that, a lot of times there's actually these panels that provide huge fire hazards. You literally can't insure them. Federal Pacific, Zinco. And when you run into those panels, you actually have to bring the house up to code, right? And that could get very expensive very quickly, especially if the electrical meters are inside, because the city is going to make you move those outside, and they cost $8,000 a pop. right? So if you got 4 or 5 of them, that could add up real quickly. Number 5, decks. So decks can get very expensive very quickly. You got to think about it, right? The cost of wood is through the roof, and decks require a significant amount of wood, especially in the multifamilies that I buy that go up 2-3 floors, right? Those 2 or 3 floor decks, they can run anywhere from 25 to 50 grand, depending on the magnitude, right? So decks can get very expensive very quickly. You have anything to add there, Artem?
Another point on decks, a lot of people think, oh, let me just do the quick fix or go the cheapest route, which is just your basic wood like pine, for example, at Home Depot. But if you really want your deck to last, think about it. It's going to be out in the elements with water, snow out here in the Northeast. You're going to want to go for pressure treated lumber, which is that green slimy kind of lumber. Or you're going to want to go for the straight up fake wood that's basically like a plastic composite. Both of those will last a much longer time, but they're going to be easily 2-3 times the cost of regular wood. And you're definitely going to want to paint it afterwards as well. So Andrew, obviously we're all about real estate here, but a lot of people actually invest either in just basic stocks, their 401k, or gold. You know, obviously crypto is getting more popular.
Totally.
What exactly attracts you to real estate? Like why do you want to go so deep into it, especially with most of your portfolio leverage in real estate?
So the reason why I love real estate so much is I'm a freaking control freak. And I love having direct control over my assets, and whether they perform or don't perform is directly correlated to my level of effort I attribute to that asset. Unlike other assets out there, like gold, like crypto, like stock, you're at the whim of these other parties to determine whether your investment's going to be a success or not. Like, I don't hire that board. I don't know, I don't control gold mines. Like, I have no control over the value of these assets, but I do have control over how much cash flow my property can produce.
Yeah, I love that. I mean, I own a piece of Boeing. That's awesome, if Boeing goes up, but then if they have some kind of big scandal, I have no control over what the stock does. But next month, when one of my contracts expires with one of my tenants, I could say, hey, rent's going up by $100. And that's a direct control of mine where I can control the rent, and I can say, hey, that extra $100 is now coming into my pocket. And I love that. Another big one for me is that there's cash flow in real estate. Now, obviously, there's stocks that pay you a dividend, but it's something about knowing exactly, like, here's my mortgage, here's my rental income, here's my bills, water, sewer, whatever, and then you have the exact amount of free cash flow that you're getting. That's money going directly to your pocket. That's money you can live off of. That's money you can go to pay your day-to-day bills. And a lot of real estate investors make a living that way. Whereas for dividends, I mean, I don't know. Those also go up and down. And of course, you have to buy way, way more of that in order to basically live off the cash flow. Like if you want to have a pure dividend stock portfolio, correct me if I'm wrong, you need to invest like $2-3 million into it before you get, $10,000 a month that it pays you. Whereas real estate, this brings us to another big point of why I love it so much is leverage. You can invest 40 grand and buy an asset that's $800,000 that pays you that same $2,000 a month to live off of, right? So go off of cash flow, you can live off cash flow and lend leverage.
Yeah, I mean, leverage is a great thing because with leverage, you can amplify your return. It's magical, right? Like if I throw 20% into a property and it increases in value by 20%, like my 20% literally doubled, right? Like that's an amazing thing that stock simply doesn't offer. Like you can use margin against stock, right?
But they won't give you the same 20 to 80. You can't say,
exactly.
Hey, I'm putting 40 to buy Boeing. Somebody else give me 800,000 and buy more Boeing.
Yeah, they'll maybe give you a 70-30, like they'll let you leverage 70% of your stock portfolio. But the downside when it comes to margin is if the stock portfolio drops below a certain threshold, they can come knocking on your door for that money, right? Like for my property, as long as my cash flow supports the mortgage, like nobody's gonna come knocking at my door. You think the bank's gonna come knocking at my door if I pay my mortgage on time every month? Like absolutely not. Like I don't care. They don't care. I don't go knocking on my tenants' doors that they pay me on the first, but I go knocking on the tenants' door that don't pay me on the first, right?
Exactly. A big one also is taxes because whether it's an owner-occupied house or it's an investment property, there's different tax advantages where you get to collect the rent up front, and that's money you get now, but then you can defer taxes on that. The asset itself has a different tax bracket than, let's say, your W-2. And on top of that, you can do 1031 exchanges, which means you don't even pay the taxes on the sale. There's so many different advantages that stocks don't offer. And I know you have some of your favorites too, right? You haven't paid taxes in years.
I have not paid taxes in years, all thanks to real estate. So real estate is so magical when it comes to tax mitigation because you have this magical thing called depreciation, right? And that allows you to write off, the value of your property over time directly against the income of the property, right? It's an amazing thing, right? But not only that, there's so many tax benefits associated with real estate. For instance, if it's your primary residence and you own it for at least 2 years, you don't have to pay capital gains on the first $250,000 if you're single, or $500,000 if you're married, right? Or you can do this magical thing called a 1031 where you can literally trade a property for another property, and any gains you had on the initial property, you could defer paying taxes in the future, right? It's a fantastic way to cascade your net worth, right? So those are just a couple amazing benefits, tax benefits of real estate.
Mm-hmm. I mean, even Brandon Turner and David Green wrote books on 5-10 different strategies for taxes on real estate. With stocks, there's pretty much only one. You buy, you sell, you pay the taxes.
Yeah, I mean, to tax defense, you could do tax loss harvesting, right? You can, utilize taxes to offset some of your gains in other areas, right? Like that's a strategy, and that may make sense, right? But real estate offers that on top of many other profit levers that stock simply don't.
Exactly.
So, I think the last point is, going back to that leverage we spoke about where, you can get, up to 80, 90, 95% leverage. Like that's fantastic. But not only that, your tenants actually pay down that leverage for you over a 25, 30 year period at times, right? So that actually allows you not only to get the cash flow from the property, but also, build this huge nest egg in the form of equity by paying down your mortgage.
And then, of course, you can refinance because when the property appreciates and you pay down some of your mortgage, you get to keep that delta, and that's directly money in your pocket.
Yeah, I mean, and just added to that point, going back to tax benefits, refinance proceeds, tax-free, right? And you want to know why? It's a loan. You do not pay taxes on a loan, right? So, like I said, there's 20 different ways to slice a cat, and real estate is one way to get it all done.
I don't really slice cats.
I don't know, man.
But all of that goes to say, that is all under your control. You decide when to refinance. You decide when to 1031 exchange. You decide when to raise rents on your tenants. Whereas with stocks and bonds, gold, you really only just buy and hang on and hope that it does well. And that's the reason I love real estate so much. I love how we were both wearing fucking light blue jeans and black t-shirt today.
I gotta do my leg. I gotta do my leg. I gotta do my leg like yours. Now I gotta match. Like, I gotta do the other leg. So it's symmetrical.
We should do it towards each other. Switch up again. There we go. Our podcast should be the Real Estate Brothers. Property Brothers or the Investment Brothers. Brothers are gay. One of us, for sure. They have wives, though, Let's get into some strategies for how you can get started in real estate. And it all depends on how much hands-on you want to be versus how much headache you want to take on. So all these strategies are geared for different folks that might have a different risk appetite,
Different strokes for different folks.
Exactly. Starting off with number one. This is going to be the least headache, but it's also going to give you the least amount of profit. Now, this strategy is good for maybe like a busy doctor that just doesn't have time to dedicate it 4 hours after work. Maybe somebody that has more of a set it and forget it kind of mentality. And that is syndications and partnerships. So what these are is where you give a chunk of your money to another partner or a group of people. They'll find the investment, they'll run the investment, and then they'll give you a small percentage of the profits for participating. But it requires no work on your end, no swinging of hammers, no answering to tenants. And that is actually how I believe, Andrew, you got started. Is that correct?
That was how I got started. I joined a syndication as a limited partner where I simply gave an investor money to invest in my money in a large apartment building. That's when I got started. That's when I wanted to find a mentor who was raising money. I didn't do it because I wanted to be hands off. I did it because I wanted a mentor, but it was as easy as me giving my money and just collecting mailbox checks.
What was your ROI on that?
So that particular opportunity was a very good ROI, and this is unheard of. So within a year, I got an 89% return on my money.
Wow.
Yeah.
But the average partnership, average syndication, what would you say for like a silent partner or somebody that's doing no work in the deal?
The average return for a syndication is probably a 15 to 17% IRR, right, on annualized, right? So what does that mean? That probably equates to, in 5 years, your money will double.
Caveat, the average stock investment, 7 to 10%. So you're already beating the market if you're just going to set it and forget it, give your money and collect mailbox.
Yeah, typically stock portfolios double your money in 7 to 8 years. So you do get a little bit of an advantage with doing the syndication model.
Yep.
Right. And not only syndications, you could also do partnerships or promissory notes, right? So you can give a note to another investor to invest at a set interest rate, right? Very little work for you. You just sign papers, right? And but at the same time, you have very little control over the deal as well.
Yeah. But your investment is still backed by the asset that they're buying.
Yeah, but there's a lien on it. Yes, if it's a promissory note, that's not the case.
Yep. So next we're going to move into our second strategy, and that is house hacking / small multifamily, which might be 2, 3, maybe 4 units. This is going to be a little bit more hands-on. This is going to be for somebody that maybe wants to get more involved or maybe has a little bit more time on their hands. Maybe they're a little bit more handy, and that's house hacking. So in this strategy, you are buying the deal and you are controlling the deal. Now, you can hire out a lot of labor and you can do some of the work yourself. You can choose to buy something that's a little bit more turnkey, but the roof leaks, that's on you. If there's a problem in the basement or the electrical system, that's on you. But at the end of the day, you're also collecting all of the profits. Now, your biggest claim to fame is your house hack that you did in Worcester. I believe Uppsala was the street name.
So my favorite, and this is how I actually got started, and this was primarily because I worked a W-2, but I also worked from home, right? So I wanted some sort of a spectrum of I wanted to be active in real estate, but I also needed the time to do my W-2. And the best strategy for that was the house hacking to buy small multifamily. And that's exactly what I did for my first particular property. I HELOC'd my 1-bedroom condo in Boston, and I used that HELOC combined with an FHA loan to buy a 3-unit in Worcester, Massachusetts, allowing me to only bring $40,000. And this thing was fantastic because I actually lived in the property, so I could really learn how to be a landlord on training wheels, right? So I more or less rented out 2 of the other units, lived in the third, and was an on-site property manager.
Now, this strategy is a little bit more involvement than set it forget it. You're still dealing with relatively small headaches. Usually, like in my experience, the average tenant might require 1 to 2 hours of work per month. That's maybe lease up or a small fix. But generally speaking, you find a tenant, you sign the lease contract, and they pay you monthly. And hopefully there's not too much headache in between. But there's obviously going to be a little bit more work. That's a little bit more work than stocks or bonds where you just buy once and forget. That's it. But generally speaking, you're not doing a ton of stuff. You're not flipping wrenches.
Well, and I think that all depends on your mindset too, right? Like, I see so many investors think they have to be the handyman, the electrician, the plumber, and also the landlord, right? And you have so much time in the day. So this strategy is great, right? But it also should be paired with you utilizing third parties. Otherwise, your time's going to get eaten up by this investment very, very quickly.
Yes. But one caveat, the more of these things that you give away, you're going to hire the plumber, you're going to hire the property manager. You are also sharing some of your profits with them, so that will cut into your cash flow a little bit. And now we're going to move on to the last strategy, which is where you make the most money, but it's also the most hands-on. Now that would be full-time real estate investing, flipping houses, being an agent, basically making real estate your full-time job. Now that gives you the most control of your investment. Going back to our first strategy, syndications, this may be you running the syndication, so you're collecting the biggest chunk of the profits.
Yeah, so this particular strategy is more or less just getting a job in real estate, right? Like if you're an agent, you got to work those hours to get that real estate commission. If you're flipping properties, it will require your time to ensure this project comes to fruition, from buying the property to renovating it to getting it on the market, right? These particular roles are very time intensive, but also can give you significant checks, right? You can get a 25, 30, 50 grand check in one foul swoop, right? So these are very powerful ways. If you are trying to go full-time into real estate, you can absolutely do this, but it will take a considerable amount of your time to be successful with this particular strategy.
Absolutely. So giving you some practical numbers, let's say you earn $100,000 at your job. That's 8 hours a day that you're spending your job. If you are flipping a duplex, for example, you buy a duplex somewhere in a secondary market, maybe you condominize it, maybe you just do some cosmetic work and sell it right away. You could make $30,000 to $40,000 profit on that flip. So you do that 2-3 times, you're already replacing your job. And that sounds great if you can do 2-3 times a year, but you're on that project every single day. You're talking to plumbers, you're dealing with the city, you're figuring out why you got denied for this permit. You're solving a lot of headaches. And that's why I always say, the more you're able to scale with the amount of headaches you're able to solve, the more money you're going to make. But just keep in mind, this is very hard to do if you also have a full-time job, also have a family, also have other commitments that you're taking care of.
Yeah, and I think it's really important, like the cheat code to cut through all of this is delegation, right? So ultimately, you can systematize flips. You can systematize your agent business through systems and through people and through processes, right? So you can I can hire a project manager to manage my flips. Yes, I'm giving away a portion of the profit, but it will allow me to do that many more flips, right? Or if I'm house hacking, I can fix everything myself. My profit will look great, but I'll more or less be an on-site handyman, right? Or I could sub it out for less profit, right? Or, when it comes to a syndication, if you actually want to be active in a syndication, you could be a general partner, meaning you could be the ones managing the deal, and you would get a better spread, a better return, but you would have to commit the time to get that return, right? So there's definitely variations that you can utilize in every one of these strategies to control that spectrum of time versus effort.
But the one point I want to make to you guys, and this is the most important point, you can get started in real estate no matter what level of headache you want to deal with. If you just want to get started, don't think real estate investing means you have to be the one swinging hammers or bringing $100,000 to a flip. Depending on your appetite and your level of commitment to the work and the money, there's so many ways of getting started, so don't let that hold you back.
You're absolutely right. Like, for example, this guy Artem right here, he's a broke motherfucker, right? But he wanted to get in real estate. I got all these flips going on. He's pretty good with managing projects, so he's getting a piece of the upside for managing a lot of my flips.
I'll actually tell you how I got started. I really wanted to get started in real estate, and I saw you doing all of these big multifamilies. I didn't have that kind of money at the time. I only had, I want to say, $15,000, $20,000 that I was ready to go set aside. I bought a condo. That condo cost me $100,000. A year later, it was $120,000. A year after that, it was $140,000, $150,000. The entire time, I was making $500 a month cash flow from that property. If I put that 20 grand into stocks, I wouldn't have made half of that money. But I got started, and that allowed me to lever that property to buy the second, to buy the third. And I was able to have a much faster growing portfolio. Just get started, guys, even with a small amount. Find a partnership. If you don't have $20,000, you have 10, split that condo with a friend. You guys both bring 10 to the table, boom, split the cash flow.
Yeah, I mean, in real estate, it's super powerful because in Artem's example, he brought 20 grand to a property, 20% down on a 100 grand property. The thing appreciated to 140, right? So what does that mean? He literally doubled his 20 grand with 40 grand in equity, right?
Yep.
Where can you do that with any other investment? That's literally impossible. Real estate is so powerful to essentially multiply your investments if you know how to play the game right.
I love it. For this one, it's all going to be about cap rates. Check it out. All right, Andrew, tell me, what is cap rate and why it's important when you're talking about multifamily?
So cap rate is important in so many components, right? It gives you so many indications on the value of real estate, right? So when it comes to cap rate, number one, it's a reflection of risk, right? So the lower the cap rate, the less risky the asset is versus the higher cap rate, the more risky it is, right? Just think about it. New York City, one of the most sought after pieces of real estate in the entire nation, right? So you would expect that cap rate to be really low, right? We're talking, 3, 4 cap rate, right? Like a really, really low cap rate versus like a Detroit, they went through that car crisis. Real estate is very, in bad shape over there, right? You're probably talking 10, 15 cap rate, right? So cap rate is a direct reflection of risk, and it's a direct reflection of people's appetite on whether they want to invest in an area or not.
And cap rate also is involved with cash flow, right? A higher cap rate means higher cash flow. Yep. Lower cap rate might mean nicer neighborhood, but not as much profit. Is that correct?
You're absolutely correct. Like cash flow is absolutely an indication of return, right? So if you're talking when it comes to a 10 cap rate, like you should expect that if you bought that property in cash, it would provide you a 10% return on your money. Vice versa, a 4 cap rate, 4% return, right? So a cap rate is indicative of the return. And as you can understand, if there's more risk, you're obviously going to expect a higher return versus less risk. You're cool with a low return.
Now talk to me about some ways how I can increase my cap rate. Now let's say I bought a building that needs a little bit of work. How can I increase that performance and increase that cap rate?
So it's a really good question. So the magical thing about a cap rate, it's a multiple on your value, right? So commercial real estate is valued based on the net operating income times the cap rate. So, right? So for every dollar you increase in net operating income, you increase the value of your property compared to the cap rate, right? So if it's a 10 cap rate and you increase your net operating income by $1, you're increasing the value of that piece of real estate by $10, right? If it's a 5 cap rate, you're increasing the value of that property with every dollar you increase in NOI by 20-fold, right? So you can see how, if you buy in low cap rate markets and you increase net operating income dramatically, it can have a huge effect on the value versus a high cap rate market, it would have less of an effect on the value.
Now, this might be a stupid question. What about appreciation? If you're talking about cap rate being a ratio of the profits to what it's worth, what if it's the denominator grows? How does that affect cap rate?
Yeah, I mean, you bring up a really good point, and cap rate is a direct reflection of appreciation versus cash flow, right? So the lower the cap rate, that's indicative. That's going to have a very high likelihood of appreciation, right? Or the higher the cap rate, it's going to have a very high likelihood of cash flow, right? And they are inversely related, right? So the more cash flow you get, the less appreciation. The more appreciation you get, the less cash flow, right? So that's really how you can utilize cap rates to really understand the relationship between appreciation and cash flow.
Got it. Now, you use cap rates to compare almost entirely different classes of buildings, right? A 5 cap rate on a 5 unit versus a 30 or 100 unit might tell you how your money might perform in that asset. But what does that tell you about the asset itself?
That's a really good point. And, not all assets are created equal, right? So if you have hundreds of units in one building, that's going to trade at a lower cap rate because, going back to my point, that's a more desirable asset and that has less risk because you have all of those units under one roof with all the same systems and less likelihood for things to go wrong, right? Versus those same 100 units in a scattered site portfolio, that's going to trade at a higher cap rate because that has more risk associated with getting the return associated with that portfolio, right? Or you might be talking about a C-class multifamily property over 100 years old versus a brick building. Same unit count, but those might trade at different cap rates because an all brick building is more desirable than an older style multifamily, typically the ones we buy over 100 years old.
What about lending? Do banks consider cap rate as part of what they lend on? Is there something that they won't lend on or just absolutely stay away from?
So banks absolutely take cap rate into account in regards to the appreciation and the value. But you also have to take that with a grain of salt because commercial lenders also restrict how much money you can take out based on the debt service coverage ratio, or more or less how much income the property produces. So typically, banks expect a 1.2 to 1.25 debt service coverage ratio, meaning you have to make 20 to 25% above the actual cost or the overhead of the property in the form of profit, right? So that's what the bank expects up front, and that may limit how much money you can take out, even if your cap rate is fantastic, right?
And now, if I had a building and I wanted to calculate my own cap rate, what are the numbers I need? How do I do it? What's the formula?
So, first of all, cap rate is pretty straightforward once you understand the formula and the variables associated with it, right? So simply just look on a map in your area. Every area has a really high growth city. Think like Austin, Texas. Think Boston. Think New York City. Think, San Francisco, right? Like those desirable markets are going to trade at a lower cap rate, right? And then when you move out from that area, farther away from those cities and less populated areas, in areas where they're less desirable to live, the cap rate will expand, right? So that 4 will go to a 5, will go to a 6, will go to a 7, will go to an 8, right? So, I think understanding geographically how close you are to desirable areas is going to give you a good indication of that cap rate expansion.
Mm-hmm. Now, tell me, how do you calculate the cap rate for your own building?
So the way you calculate the cap rate for your own building is simply looking up comparables in your particular area, right? Like, what are commercial properties selling for in this area based on the net operating income? You can reverse engineer what the cap rate is, right? So you would simply do that based off what, similar commercial properties trade for in your area. So when it comes to calculating cap rate, we mentioned earlier, the value of your property equals the cap rate times the net operating income, right? So if you're trying to figure out what the cap rate is, you're simply gonna divide the net operating income over the property value, and that's gonna show you what the cap rate is in that given market. And the thing about cap rate, and the reason why I make so much money in real estate, is because I don't buy based off current cap rate. I buy based off pro forma or future cap rate, or the cap rate that it will be once it gets post stabilized, right? So for example, I might be buying in a market where the cap rate is 6.5% to 8%, and when my business plan is complete, the property will produce 11 to 12% cap rate, right? That's 11 to 12% return on your money in a market that normally gives you 6.5% to 8%. And what does that translate to? That translates to you being able to suck equity out in the form of a refinance, in the form of a sale, in the form of a 1031.
In addition, if you're trying to look for a diamond in the rough, maybe the market in your area has an abnormally large or an abnormally low cap rate based on all the other properties around it. That might give you an indication. Maybe there's some value add opportunity. Maybe there's something that you could possibly fix that the current property manager isn't doing, and that could give you increased profits.
So here's a pro tip on finding opportunity, right? So in every one of these cities, these developers submit permits, right? And certain particular areas in the city might have more activity than others, right? So if you see a large increase in permits in your area, maybe some large developments in that particular area, you can assume in the future that the cap rate will get lowered, because that would be a more desirable place if there's new buildings go up there, right? So that's a way to identify, potential opportunities in the market where cap rates will be condensed, and you could buy into that before that actually happens. Tune in next week on the next episode of the Freedom Real Estate Podcast.